Marcus has owned the same sedan for 6 years. It has 112,000 miles, a faded bumper, and a resale value that keeps shrinking. He has not added a teenage driver. He has not received a speeding ticket. He has not filed a claim. Then his renewal arrives. $428 a month. The car is older. It is worth less. So why does protecting it cost more? Because Marcus is not really paying to insure one car. He is paying to insure two. The first car is the one sitting in his driveway. Its value falls every year. The second car is the one he might hit. That car may be newer, more complicated, and far more expensive to repair. Its driver may need medical care. A claim may involve a rental vehicle, legal costs, or damage to several cars. Your car getting cheaper can reduce one part of your policy while the rest of the policy becomes more expensive. That is the contradiction hidden inside the renewal notice. Most people think an auto premium works like a price tag attached to the vehicle. A $20,000 car should cost more to insure than a $6,000 car. Sometimes it does, but that logic applies mainly to the coverage that pays for damage to your own vehicle. A typical policy is a bundle. Liability coverage pays when you injure someone or damage property. Collision coverage helps with damage to your own car after a crash. Comprehensive coverage deals with losses such as theft, hail, fire, vandalism, or a falling tree. Then there may be uninsured motorist coverage, medical coverage, rental reimbursement, roadside assistance, and other options. Only some of those prices are tightly connected to what your car is worth. Liability does not care that your sedan has lost half its value. If you slide into a new pickup truck, the pickup does not become cheaper because your car is old. If another person is injured, the hospital does not price treatment according to your odometer. That is the first reveal. Depreciation lowers the value of the thing you own. It does not necessarily lower the cost of the damage you could cause. Imagine Marcus asks for the itemized version of his $428 bill. In this hypothetical policy, liability costs $214 a month. Uninsured motorist and medical-related protection cost $91. Collision costs $78. Comprehensive costs $29. Rental and roadside options add $16. The two coverages most directly tied to his own car add up to $107. The other $321 are mostly pricing the world around the car. Now compare that with the previous renewal. Collision had actually been $9 more expensive. His aging car did reduce that portion. But liability, uninsured motorist protection, and other charges rose by more than the collision savings. The age of the car helped. It simply lost the argument. This is why a clean driving record can coexist with a higher price. Your record influences your personal risk class. Avoiding tickets and crashes may protect you from additional surcharges, but it does not freeze the insurer's base rates for your location, coverage type, vehicle group, or pool of similar drivers. Insurance is a forecast. The company is estimating the frequency of future claims and the likely cost of those claims. It uses information such as the vehicle's age and model, where it is kept, how it is used, annual mileage, selected coverage, deductibles, driving history, and other factors permitted in that state. You experience the policy as one monthly number. The insurer experiences it as a stack of probabilities. That stack can change even when you do not. Repair labor can become more expensive. Medical claims can cost more. Theft patterns can change. Hail, floods, or other severe weather can produce more comprehensive claims in a region. The number of uninsured drivers can affect the cost of uninsured motorist coverage. A specific year, make, and model can develop a worse loss record as insurers collect more data. And rate changes often arrive late. A rise in claim costs does not always appear in your bill immediately. Insurers may need to analyze the losses, revise their pricing, file rates with a state regulator, and then apply the change when policies renew. The bill you receive today may be reacting to costs that started climbing months earlier. That lag makes the increase feel personal. You see the same car and the same driver. The insurer sees a newly priced risk class. There is another detail that makes the title more complicated. An older car is not automatically cheap to repair. Its market value may be low, but a repair shop still charges current labor rates. Some parts may be harder to find. A minor crash can require more labor than the car's value seems to justify. And when the estimated repair cost approaches the vehicle's actual cash value, the insurer may declare it a total loss. That does not mean an older car always raises the premium. Often, collision and comprehensive coverage become cheaper as the vehicle depreciates. The important point is that vehicle age is not a simple discount switch. Insurers also look at the claim history of that exact type of vehicle and the cost of settling losses connected to it. The national numbers tell the same story in a surprising way. In the Bureau of Labor Statistics reading for May 2026, the Motor Vehicle Insurance Price Index was 2% lower than a year earlier. At the same time, motor vehicle maintenance and repair prices were up 6.1%. So the broad insurance index had started moving down, while repair costs were still rising. That does not mean your renewal must fall. A national index averages many policies, companies, states, drivers, and coverage choices. Your insurer may be repricing your area. A discount may have expired. Your mileage estimate may be outdated. Your vehicle group may have different loss results. Or the company may simply no longer be competitive for your particular profile. The average can fall while your bill rises. That is not a contradiction. It is a reminder that an average is not a quote. So what should Marcus do? Not start by cutting liability. That is the most common mistake in the logic of an old car. People think, the car is worth less, so I need less insurance. But a lower vehicle value mainly changes the decision around protection for the vehicle itself. It does not reduce the financial damage that a serious liability claim can create. Instead, use what we can call the two-car renewal check. The first car is yours. The second car is everyone else's. Start with the second car. Ask for the exact price of liability, uninsured motorist coverage, medical or personal injury coverage, and any other protection that responds to harm beyond your own vehicle. Review the limits, not just the premium. These are the coverages that protect income, savings, and future options when a loss is larger than the value of the car you drive. Then, examine the first car. Find a realistic current market value for your vehicle. Subtract the collision or comprehensive deductible. The result is a rough estimate of the maximum net value that coverage may protect if the car is totaled. Suppose Marcus's sedan is worth about $6,800 and carries a $1,000 deductible. His rough maximum net recovery is $5,800. His collision premium is $78 a month, or $936 a year. Comprehensive adds another $348 a year. That does not automatically mean he should drop either coverage. It gives him the missing comparison. If Marcus still has a loan, the lender may require both collision and comprehensive. If the car is paid off but he could not replace it after a total loss, keeping coverage may buy valuable stability. If he has enough savings to replace the car, drives very little, and is paying a large percentage of the car's net value every year, changing or dropping collision may deserve a serious look. He might still keep comprehensive because theft, hail, or weather risk makes it worthwhile. The correct answer depends on his ability to absorb the loss, not just the age of the car. That is why rules such as drop full coverage after a certain mileage are too blunt. Two people can own identical cars and make different rational choices. One has an emergency fund and a second vehicle. The other would lose the ability to get to work if the car disappeared tomorrow. The spreadsheet can be identical. The risk is not. Next, Marcus should request quotes from several insurers using the same limits, deductibles, drivers, mileage, and optional coverages. This detail matters. A cheaper quote is not a saving if it quietly removes uninsured motorist protection, lowers liability limits, or raises the deductible beyond what he can pay. Compare identical policies first, then test changes one at a time. What happens if the deductible moves from $500 to $1,000? What happens if an unnecessary rental option is removed? Is the annual mileage accurate now that the commute has changed? Are there discounts for bundling, automatic payments, defensive driving, low mileage, or vehicle security that are actually available and appropriate? Do not ask only, can you make this cheaper? Ask, which line changed, why did it change, and what am I giving up if I remove it? That question turns one mysterious bill into several understandable decisions. And sometimes the uncomfortable answer is that nothing about you caused the increase. Your insurer's pricing changed. The market around you changed. The expected cost of the next claim changed. That does not make the bill painless, But it does remove the false lesson that an older car should make the entire policy cheaper in a straight line. Your car's value and your insurance premium are measuring different things. The car's value measures what one aging object could be sold for today. The premium measures the future cost of uncertain damage involving that object, its driver, other people, other vehicles, and the place where all of them meet. One number is depreciation. The other is risk. So when the next renewal arrives, do not look only at the total. Separate the two cars. Protect yourself from the damage you could cause. Then decide how much protection your own aging car is still worth. A smaller car value should trigger a review. It does not guarantee a smaller bill. What changed faster for you? Your car's value or your insurance premium? Share the part of your renewal that surprised you most, and subscribe for calm explanations of the expensive systems hiding inside ordinary life.